Hi guys, today we'll discuss Farfetch earnings as well as investor guidance. Before we start, please don't forget the financial disclosure. This is neither a buy nor sell recommendation on a stock, and I'm not a financial advisor, so please remember to do your own research. I've derived a target price of $18.8 for the stock, representing an upside of 27%. This stock was recommended by Robert, so shout out to you for this. Farfetch share price has been on a roller coaster since its IPO. Prices rocketed as high as over $60 as it became a pandemic winner, with luxury sales moving online. But the share price has been on a downward trend as investors pondered how the business will fare when life returns to normal, coupled with increasing risk premiums over these few months. Just after reporting earnings, the stock had jumped almost 50% from opening prices on that day, but quickly erased the gains. Now trading at below IPO prices, is this stock a good buy? Let me do a quick company overview for those who aren't familiar with the stock. Farfetch is a luxury-focused e-commerce platform. Its GMV comes from 1P sources, which are inventory owned by Farfetch themselves, 3P sources, which are third-party supplies sourced from brands and retails, as well as its brand platform. Its brand platform is from its New Guards Group operation, which is a brand incubator platform which develops new Farfetch exclusive brands. My investment thesis is as such. Farfetch is the leading marketplace for luxury sales, and the underpenetration of the online luxury market offers a long growth runway for the company. And secondly, the company's expansion to the luxury market in China unlocks tremendous growth opportunity. But investors should also take note of these key risks. Firstly, luxury sales may be returning to offline channel as the pandemic abates. And is there a permanent consumer change in behavior? Secondly, headwinds in China such as regulatory risk or potential taxes on the rich may impede the luxury sales growth in the region. Thirdly, the volatility in take rates and the potential for competition to bring down take rates may impact the profitability of the company. And lastly, rising rates will negatively impact pre-profit stocks. For my valuation, with a revenue growth CAGR of 22% from FY21 to 26 and 8% from FY26 to 31, brings me about a target share price of 18.8, and I've assumed terminal EBITDA margins of 25%, a WACC of 9.8%, and a terminal growth rate of 3%. Let's move on to our first thesis. According to Bain, the global luxury goods market was worth $324 billion in 2021, and Bain is forecasted the market to be between $412 billion to $435 billion by 2025, translating to a 5 to 9% CAGR. E-commerce penetration was only 22% in 2021 and is projected to reach 30% by 2025, translating to a size of $124 billion to $131 billion. Farfetch reported a total GMV of $4.2 billion in 2021, meaning roughly a 6% share of the online luxury market. Assuming its market share expands to 8%, this will translate to an annual 25% growth CAGR in GMV. Let's move on to our second thesis, which is Fetch foothold in China. The luxury market is one that requires a lot of adaptation to local cultures, and this is especially true for China. It was reported that in 2019, China was the largest consumer population of luxury goods, with a market share of 33%. But in 2021, Chinese consumers dropped to 21% of total consumption. That's it. This shows the tremendous opportunity that is present in China's market. Fetch has been initially operating in China via its own app as well as a failed partnership with JD for a few years, which was wound down in the fall of 2020. But in November 2020, it announced its JV with Richemont and Baba for a combined $500 million, representing 25% of valuing the China all-in JV at $2 billion. Importantly, the JV expands Fetch's access to a Tmall platform and its more female-skewed, fashion-oriented 700 million members via its luxury pavilion. This in contrast to its prior JV with JD, whose demographics are skewed more towards men and with some category misalignments. In addition, in early 2020, the company received a capital investment from Chinese tech giant Tencent, which is the owner of the prominent WeChat app. And as all of you know, WeChat is the app that is used by virtually all Chinese people. And this further strengthened its credibility in the region, while also helping brands reach Chinese consumers and aiding their relationships with the brands that sell on Fetch's platform. Therefore, the main bull thesis on Fetch is its opportunity for growth in China. Let's talk about some of the key risks of this stock. The company charges 30% on its 3P platform, and this is one of the highest take rates among publicly traded platform businesses. Therefore, if there are any emerging new competitors in this space, take rates can decrease and thus weigh on profitability. In addition, as a 3P seller, if luxury brands decide to focus more on direct-to-consumer, they may lose their bargaining power and we could see a decrease in take rates. And one of the biggest questions about these e-commerce stocks are their path to profitability. The company has posted positive adjusted EBITDA margins in the third quarter of 2021 and the fourth quarter of 2021, but do not be fooled by these numbers. EBITDA margin, if stock-based compensation is not added back, remains negative. It is also evident by comparing these two graphs that stock-based compensation is extremely high in 2020, and this should be taken as a real expense as dilutes shareholders. However, it is still a good sign to see that EBITDA margins are finally trending upwards and moving in the right direction. Now let's go over their key takeaways from the FY21 results. Fetch delivered a strong set of FY21 results after a disappointing third quarter of 2021. Its GMV growth came at 22%, which beat consensus of 20%, with adjusted EBITDA at 36 million, beating the consensus of 33 million. GMV was also strong as average order value was at an all-time high of $635. Adjusted EBITDA margins expanded, reflecting declines in SG&A and tech expenses as a percentage of revenues. In addition, one key highlight is that Fetch has been able to pass on higher costs to customers and partners. According to the company, Fetch has renegotiated the take rate with 65% of partners starting the first quarter of 2022. In addition, it has also been able to pass on higher freight costs associated with logistics to customers. And this means that margins will not be badly impacted in this inflationary environment. Let's take a look at the Fetch FY22 guidance. The company was positive on 5 key messages. Firstly, the digital platform GMV will grow at 28% to 32% year-on-year and margins will continue to expand. Secondly, management confirmed that discussions with Richemont will continue. Thirdly, the fulfillment by Farfetch is picking up and large brands are already using the consignment service. Fourthly, Farfetch will launch into the beauty segment and this will drive further growth. And then lastly, the group will further develop Farfetch Media Solutions, which is an advertising service that can further drive margins. Lastly, let's look at the valuation of the company. I've done a quick DCF for Farfetch. For revenue growth, I've assumed that revenue grows from FY21 to 26 at a CAGR of 22% and 26 to 31 at a CAGR of 8%. EBITDA margins with share-based compensation not added back because it is a real expense from negative 9.5% in FY21 to 25% by FY31. Currently, depreciation and capex are at high single digits as a percentage of revenue, but this is expected to come down as this should be an asset-light business model in future. I've used mid-year discounting to obtain the free cash flow of the company. And because there is negative cash burn for the first few years, the present value of unlevered FCF in the projection period consists only of a small part of the enterprise value. In terms of determining WACC, I have counted the company's convertible debt and lease liabilities as debt for the calculation of WACC. Using a cost of equity of 10.5% and a cost of debt pre-tax of 6%, WACC would be 9.8%. However, in the enterprise bridge to derive equity value, I've only included lease liabilities as debt and converted the convertible debt to outstanding share count, as dilution will happen in the future. With that, I've arrived at a value per share of $18.8. I've also done a sensitivity table to derive a range of target prices with varying WACC and terminal growth rates. I think that with the volatility in the markets these days, the shares of Fetch are underpriced. That said, with everything going on in the markets these days, it does not mean that there is no downside to this stock. That's all for today. Consider subscribing and see you next time.